Hi, Chris Siamof with Berkshire Hathaway Home Services, and I'm in Appleton, Wisconsin with Pam Beattie of Waterstone Mortgage.
Thank you for having me. It's great to be here.
And we're going to talk about the 5 reasons we don't think the housing market is going to crash. Number 1, low inventory, record low inventory, but yet demand. Number 2, there's stricter lending standards than there were, guidelines than there were 14 years ago. There's more equity in everybody's home due to house appreciation. Number 4, we have the largest pool of buyers ever, 71 million.
Yeah, close to that, yep.
And the foreclosure rates. You know, the government helped out during COVID and foreclosures are record lows. So we're going to get into depth more about the 5 reasons we think the housing market isn't going to crash. First, number 1, inventory. Inventory throughout the country is low. In the Midwest, typically the up to 350 range, we have less than 3 months inventory. You're in a balanced market when you have 6 months inventory. We're currently in a seller's market. And because there are so few homes trying to keep up with demand, there were 14 years of underbuilding.
Yeah, about 14 years of underbuilding where the number of home completions, which is what they call it when they measure that, home completions, number of homes completely built, did not outpace what they call household formations. So a household formation, I guess we would also call that maybe a first-time home buyer, is, you know, when that household is forming. So when you have 2 people getting married, moving on to the next stage of life, that's a household formation. We have so many more household formations right now than we have home building completions. Coupled that with the low number of people selling their already built homes, and we just have a supply and demand imbalance that is causing that low inventory.
And I've heard estimates that there's almost 71% of homeowners have a mortgage rate. Thanks, Pam. 4 or under, so we can understand why they maybe don't want to. And do you want to speak to today's rates?
Well, no. Yeah, it's no secret. Rates have definitely gone up, and people being locked in at that lower mortgage rate could be one of the reasons why they are not actively putting their homes on the market and selling. Of course, we could do a whole nother video on why you can't just let that low mortgage rate fool you into keeping a home when maybe you want to move on to something bigger, better. Different video for that. But yes, we have people with a lot of low interest rates. We have a lot of people looking to buy. We have underbuilding for 14 years, and all of that has created this low inventory.
Reason number 2, Pam is going to speak to.
Stricter lending guidelines. I'm sure this must be everybody's favorite topic to talk about, but I'm sure there's many of you out there, if you did buy a home in the early 2000s and you have since bought another home after the crash of '08, you have noticed that to obtain a mortgage, there is much more documentation needed. There is much more stricter lending guidelines. That ensures that we are writing some of the cleanest paper. We have the lowest delinquency rates that we've ever seen because they have tightened those underwriting guidelines, and that is for our own good, to make sure that we are putting well-qualified buyers into homes.
And I've heard the median credit score is 769, which is phenomenal. And I've heard the term used, liar loans in the early 2000s. I see a smile.
Right, no liar loans. I think there were many names for them: stated income, stated assets, no income, no assets. There was a lot of, I guess, what we could say stated programs where the buyer would just state what they earned or what they had in the bank, and there was no documentation to back that up. Today, anybody who's recently bought a home will tell you we ask for a lot of documentation to back up your income, your assets, those 2 things especially.
Thanks for speaking to that. Number 3, people have a lot more equity in their home they did even 5 years ago. You know, we've had double-digit appreciation. That means you have more equity. So on average in the United States, people have $274,000 in equity. Now the median home price is $430,000. So people are not upside down. They're not in a position where they're going to lose their home. So that makes a big difference in than it did in 2008. Number 4 reason why we feel that the housing market is not going to crash is,
well, actually that has to do with the largest demographic in the United States right now. So Chris, I think maybe the end of the baby boomer era. I myself am at the kind of the beginning of that Gen X phase. But right now we have millennials are in that first-time home buying range. Statistically, the average age nationwide of a first-time home buyer is 33. So if you go back about 33 years ago, that is going to put us right in the millennials. So all of these millennials are starting their household formations. They're looking for homes to buy. And they're the largest generation, even larger than the baby boomers. We are going to have demand for quite a while until these millennials kind of get settled into their first homes and we move on to the next generation.
And millennials were born from 1981 to 1996. They represent 72 million people. First-time home buyers account for 30% of all transactions. 26% of all transactions, Pam, are cash.
So sad for us mortgage lenders, but yes.
And, mortgage rates a year ago were, as low as 5. Now they're 7 or 8.
They're in between. Yep, in between 7 and 8. Many factors will determine your interest rate, but there is no doubt that interest rates are higher, and the media likes to keep us apprised of all that negative information.
And number 5, the reason we feel that the housing market isn't going to crash
is we are at the lowest rate of foreclosures, probably ever since they have been tracking that. And one of the reasons why is back during the pandemic, when most people were probably going through the hardest economic times they have faced, our government stepped in and actually put a moratorium on foreclosures. So lenders were not allowed to foreclose, and they did have forbearance programs that came out and different ways to help homeowners hang on to their homes during that pandemic crisis and the unemployment crisis that kind of went hand in hand with the pandemic. And what's interesting about that is a lot of people, when they came out the other side of that forbearance program with all their payments made, on-time payments, all caught up. But that really did help people not have to file foreclosure during the pandemic. And you take that coupled with the fact that a year or two before the pandemic, all the way through the pandemic, including up to today, we have still seen home values appreciate. That goes back to the number 3, which was the more equity in the homes. People have so much equity in their homes right now, they would not let their home go into foreclosure. If they had a situation that put them in a spot in life where they could no longer afford to make their mortgage payment, they're going to call their local trusted real estate agent and get that home on the market, sell that home, and pull that equity out as opposed to foreclosure.
I think you spoke to some good points there. The difference between now and 2008, 2010, we have more documentation with our loans. Mm-hmm. People have more skin in the game with their house. Mm-hmm. They're not upside down. Short sales should not even be an issue, I would think, in this market. So in summary, let's talk again. So we have low inventory. We have a 14 years of underbuilding. We have stricter lending guidelines. We have more equity. We have the largest pool of home buyers, first-time home buyers, right? The largest pool of first-time home buyers that's really driving up that demand with the household formations. And we have low rates of foreclosure. So I think it's really, in summary, I think it's really important to not make generalized assumptions on when the market's going to crash, but really dig in, talk to a local expert, and find out the statistics behind the current market. And as always, talk to your local lender, talk to your local realtor. Don't believe all the hype. I mean, they're just trying to, it's clickbait. They're trying to get you to buy into some drama. There really is no drama in the real estate market. The real estate market, housing drives the economy. The rates, unfortunately, didn't come down to where we wanted to because of credit card debt.
And inflation. I
And
mean,
inflation.
I think as long as inflation remains on the higher side, the Federal Reserve is going to keep the Fed funds rates higher. That does have a trickle down effect to your mortgage rate. But everything is cyclical. Everything in our industries is cyclical. So these rates are going to come down again. So I certainly would not let an interest rate deter you from buying a home, because you can always refinance that rate down the road.
And we need you to sell your home so we have some inventory. So these 72 million millennials have homes to
Call their own.
call their own. And that's really what it's about. And Pam, you've been doing this a long time. I won't put you on the spot.
Maybe 27 years-ish.
And I've been doing it close to 20 years. And you know what? We'd love your referrals. We'd love to have you comment below if there's a topic you'd like us to talk about. We just touched on credit card debt. If you'd like to find out about how Pam can maybe, do a consolidation loan for you.
Yeah, any comments you have, any questions you have, because we're really here to help get your questions answered.
And till next time, thanks.
Thanks.